So here's a weekly recap of my portfolio. So it's slightly up to $89,000. And in my margin account, I still have put spreads on the SPY. I've got 5 that are currently open. But because the market pulled a fast one on us by falling all the way to 272 on the SPY Wednesday, I had to adjust 2 of my put credit spreads by selling a call spread against them. So I sold for the 275 put spread, so the 275 got breached, so I sold a 295-300 call spread for mitigation. And I did the same for the June 8th expiration. I sold a 300-305 call spread for mitigation as well. This one had a short put of 274, which also got breached on Wednesday. So the May 29th one has 11 days to go until expiration. And for me to win on this trade, I just need the SPY to trade below 295 and above 275 come May 29th. So I've got 11 days to go. So it is possible, depends what the market is planning on doing. That's the thing. I've noticed that with my new portfolio. So first of all, if we look at all of my accounts at the same time, you can see how clean it is right now. In my margin account, I just got SPY put spreads. In my TFSA, I only have the Q ETFs. In my RSP, I only have IWM ETF. In my RESP, I've got Dell and MasterCard. So I really like my new portfolio. Very clean. And basically all I do every day is just look at the SPY. I wake up in the morning, first thing I look at is Yahoo Finance, and I just look at what the SPY is trading at pre-market. Much less of a headache to just look at one stock all day. It represents the general market. It's the top 500 stocks on the US stock exchange. And most of the stocks that are part of the SPY, that make up the SPY, also make up the Q ETFs. The Q is more based on tech stocks, but most of these big tech stocks are part of this SPY ETF. And they usually move the same way. So just by looking at one stock, which is the SPY, it's giving me enough information on my other positions. So this May 29th one, it has 11 days to go. This June 8th has 21 days to go, so 3 weeks. And for me to win on this trade, I need SPY to trade above 274 and SPY to trade below 300 at the same time. But as time goes by, as we get closer to expiration, I could close this trade earlier if the SPY trades far enough from both extremities. So the same thing would apply for the June 10 expiration, except this one is just a put spread. There's no call spread against it. So all I need to win on this one is for SPY to trade above 270. Anywhere above 270, I win on this trade. And like the other trade, I don't have to wait till expiration. As we get close to expiration, as long as the SPY is far enough from 270, I can close the trade early. June 12 has a 265 strike and has 25 days to go. Once again, as long as the SPY trades anywhere above 265, I make money on this trade and I can close it early if the SPY is trading far enough from the 265. And then the June 15 has a 260 strike. So it's even safer than the other put spreads I have. And the reason it's even safer and further away is because the market was dropping when I sold this put spread. It was on Friday that I sold this put spread and I collected, I believe, $75. Yes, I collected $75. Right now, the SPY closed at 286. So currently, all these put spreads are safe. Sadly though, this call spread, the 295 call spread and the 300 call spread worries me a little bit. If the market continues to go up, then this 295 and this 300 strike can get tested, which is a bit annoying because I had to sell them when the SPY was trading at 272. I mean, it doesn't make sense. On Wednesday, it reaches 272 and then Friday it closes at 286. Just ridiculous. It's almost like the market pulled a made you look move on us. Now in my TFSA, if you've been following my videos, you know I've got a covered call on the Qs. My cost on the Qs is 221. When the Qs dropped all the way to 167, all I could do is sell weekly covered calls on them, but I was selling out of the money covered calls. So let's say Qs is trading at 167, I would sell a call option at, let's say, 175, ending in 1 week with an expiration of 1 week. So what that does is it gives me credit. I get to collect the premium, but it's not for free, of course. The consequence of selling a call option against my shares is if by expiration the Qs is trading above my strike of 175 in this example, then I lose my shares at 175. Now, of course, I don't want to lose my shares at 175 because my purchase price was 221. But because I'm going far out of the money, so if the stock is trading at 167, I'm selling a call option at 175. It's pretty far from 167 and it's only 1 week away. So basically, I just need the Qs to stay below 175 under 1 week, which is very doable. So it's been going well. I've been doing this since the SPY was trading below 170 and never got in trouble until the week where the SPY went up 11% in 1 week. So until this week here, so the week of April 9th, I sold a 199 call on the Qs, and I believe the Qs was trading at 190. It ended up surpassing 199 before April 9th. So what I had to do is I started rolling my covered call higher and further. So what I did is I had to buy back the 199 strike because I don't want to lose my shares at 199. So I had to buy back the 199, which you can see on this line here. I bought back the 199, and I sold the 203 strike. So I went from April 9th expiration to April 17 expiration. So I bought back the 199, sold the 203 strike, but I collected 50 cents or $50 to do that. So I moved my strike higher while collecting a credit. And then the week after that, same thing. I went from April 17 to April 24th expiration. I went from the 203 strike to the 204 strike. So I was only able to go 1 point higher, but I did it for $60. And then the week after that, same thing. I went from the April 24th expiration to the May 1st expiration, but I was lucky I was able to go further. I went from the 204 strike to the 208 strike. So I need to go higher because my cost or my purchase price is 221 and I can't afford to lose my shares below 221. So I keep going higher, as you can see, from 204 to 208. So actually, initially I went from 199 to 208 now, and I keep doing this for a credit, 50 cents, 60 cents, 50 cents, or $50. And then April 30th, I went again from May 1st expiration to May 8th expiration. I went from the 208 strike to the 209 strike. So I was only able to move up 1 point as well. Collected $38 this time. And then once again, the next week, May 1st, I went from the May 8th expiration to the May 15 expiration. I went from the 209 strike to the 211 strike. So I was able to go up 2 points, collected $40 while doing that. And then once again, finally, the week after, or last week actually, on Wednesday, so May 13, what I did is I went from the 211 strike to the 212 strike from May 15 to May 22nd. So this is the last one that I have. I'm sitting on the 212 strike expiring May 22nd, and I collected $50 to do that. So as you can see, I keep collecting small credits every time I'm rolling my call option forward. Reason being is I don't want to lose my share once again below 221. So right now my current position is a covered call at a 212 strike. So I'm in the money right now. So I need to do it again for sure. But I'm going to get closer to May 22nd. I'm going to wait to see what happens. Maybe the Qs drop again like it did this week. It almost reached 211 this week actually. I think it reached like 214, 215. So who knows what happens this week. I'm basically hoping for the Qs to come back down so that I can turn this covered call into a safe trade. If it doesn't, I'll just keep rolling forward and forward. So now obviously the goal is if the Qs keep flying or moving forward faster than I'm able to roll my call option forward, that's going to be a problem. But market always comes back down. So eventually it's going to come back down, so I'll be able to catch up. So that's where I'm sitting at right now. Purchase price of 221, but the Qs is trading 223, but I can't take advantage of that because my maximum selling price is 212 because of this call option that I sold against it. But I'll just keep rolling forward for a credit. But I do have an extra 34 shares that are not part of the covered call trade. At least this one's showing a small profit of $72. Now, in my RSP, I've got IWM ETF, which tracks the Russell 2000 index. So it's the exact same situation as the Qs, except that I'm not in the money. My purchase price is 151. the stock is trading at 125, and my next week's covered call strike is 134. So this one is safer because I'm not in the money like I am with the Qs. And I keep doing this, keep rolling it forward for a credit. So even if I'm down on the underlying stock, I'm still generating something from my position, which is selling call premiums. So I see it as a dividend, but a higher yield dividend. So IWM does pay a dividend, but I mean, it's only 2% per year. For me, that's annoying. But with selling call premiums, for example, 36 cents in 1 week, that represents a yield of 36 cents divided by, what's the cost right now? 125. So that's a 0.2% weekly yield. So multiply by 52, that's like 15% yield. So that's why I keep selling these call premiums, because it acts like a dividend boost in my opinion. So why am I selling on ETFs? Why do I only have Q ETFs and IWM ETFs? The reason being is ETFs, or the general market, always goes up. But individual stocks, you never know what could happen. I've had enough experience to buy the stock that drops 30% or 40% and never comes back up again. So I decided to just stick to ETFs because I know even if they drop, I know eventually they're going to come back up. It's almost guaranteed. So I'm not too worried if an ETF drops because I know that it's just a matter of time before it comes up. And while it comes back up, I'm selling call options on a weekly basis. And what I like about the Qs and IWM is that they have high volume, high liquidity, lots of strikes. So it's more manageable, more flexible when it comes to rolling my call options forward. And now finally, in my RESP, because I don't have enough capital, I couldn't do it on an ETF. So I did it on Dell, which is a company that I like. I bought the stock at $39, 39.66. Right now it's at $42. But I bought it a while back. I bought the stock March 6th. So if I'm selling covered calls on it, but if I wasn't selling covered calls on it, I'd be up $243. But I've been selling covered calls on this since March 6th. And if we look at how much I've collected on Dell from selling covered calls. So in the first trade, initially I collected about $45. And then this trade here, you can see I collected $90. And then on this trade, $124, then $170, and then $180. So I collected $609 US by selling call options on Dell, which in my opinion, I think is better than just holding it. Because if I was just holding it, I'd be up only $243. And guess what? On Wednesday, it was trading at $40. So on Wednesday, I was actually up nothing. But because of the call premiums I'm collecting, I made $600 that I get to keep from Dell just by selling call options. And MasterCard, this is just extra money that I had. Not enough to do any covered calls, of course. I could only buy 6 shares. So I just buy MasterCard for capital appreciation. And this is something I'm going to hold for 15 years. I don't plan on selling it, so it's just a stock that I'm going to keep forever. Alright, just wanted to share with you my portfolio. So if you have any questions, leave them in the comment section below. And if you're going to open an account with Questrade to trade on the stock market, use one of my referral codes below. The first one can give you up to $250 back, depending on your deposit. So $1,000 gets you $25, $10,000 gets you $50, $100,000 gets you $250 back. Or you could use this referral code that gives you $50 in free trades, as long as you open the account with $1,000 deposit, of course. Thanks for watching.